Righty-ho. A very good morning, ladies and gentlemen, and greetings from what is a particularly soggy Cornwall this morning. But welcome to Hawksmoor's ESG seminar on how we can hopefully not only successfully navigate through what's coming all our ways ESG-wise, but to fully embrace ESG and the opportunities that its imposition is going to bring to us. So this morning we have two speakers for you. I'm doing the opening slot. For those who don't know me, I'm Jim Wood-Smith and I'm Chief Investment Officer at Hawksmoor. And then the second half of the presentation, James Clark will take up the reins. James is our Senior Fund Analyst and leads our ESG and sustainability research. So the agenda for the next 30-35 minutes or so, what we'll do is to have a look through the regulation of what is coming our way or what may already have happened. We'll have a look at how we think we should all best how we should all best understand and use ESG. We'll have a look at how we think we can successfully build ESG into the suitability and fact-finding process. And then we'll have a look at how we have to build ESG into the investment process. And then we'll wrap up with having a look at how Hawksmoor's sustainable world will hopefully bring the whole thing together. We'll have time for questions and answers at the end. There should be a Q&A button at the bottom of your Zoom screens. If you do have any questions as we're going along, please do submit them and they will, by the process of the magic of the internet, find their way to us. But as well as saying what's on the agenda, I think it's very important to say what's not on the agenda for this. And this is not an advertisement for whether ESG is a good way of investing or to try and persuade anybody that it might not be a good way of investing. That's by the by. It is going to be a regulatory requirement and we shall all have to deal with it, whether we agree with it or whether we don't. So, regulation. What is actually happening? Well, thus far, not very much. It is in the very near future. And what is happening ESG-wise starts in Europe and the European Union. And the European Union takes climate change and environmental issues and sustainability issues incredibly seriously. It is absolutely committed to Paris 2015 or COP21, whichever name you wish to give it. And as part of the EU's belief and commitment to this, it is tweaking MiFID II. And this is part of a wider program across all of financial services and all regulation of those who are involved with advice, wealth, or managing investments. It is coming all our way. We are just seeing the MiFID II end of it. The FCA is going to be absolutely committed to it too. The new chief executive of the FCA, Nikhil Rathi, is very, very keen on ESG issues. And where we currently are is that it is expected that the FCA will give us all guidance on what we're going to have to do before the end of the current year. And that will be fair warning that there is actual regulation coming in what is expected to be the first half of 2021. So what we're all doing ESG-wise at the moment is to get in front of the curve. And what that curve is going to say is that we would all start to take account of ESG preferences in our suitability process. And the ESG preference and the documentation of that will become as integral to the suitability process as what are now such everyday phrases to us as capacity for loss and tolerance of risk. It will become very, very much business as usual. So, having said that we have to understand our clients' ESG preferences, what does that mean? Well, there's sort of a difficult way to do this, and there is a much easier and more practical way of doing it. And the difficult way and the wrong way is to get bogged down in detail. And there is an awful lot of detail. But that, we think, is largely a blind alley. If you get the ESG and the sustainability process and conversations right, what it is the basis for actually much better engagement with clients. And the better the engagement with the clients, the better the ultimate outcomes are going to be. And we think that ESG is actually a big step forwards. So what does that actually mean? We have to ascertain clients' attitudes to sustainable investment principles. And we think that to get it right, ESG is just one leg or one part of this. It is a bit of detail in what should be a wider process. It shouldn't be just compartmentalized ESG. But what we have to do on the face of it is to ascertain and document our clients' attitudes towards environmental issues and how these affect the corporate issues and company profits. The same for societal issues, and also the same on issues of governance best practice. But it is also very important to say at the outset that this is not intended to be divorced from the financial aspects of what we're doing. This is not a separate stream or a separate strand. And it has to be linked with the financial return too. And in this aspect of it, we're going to say that we think it is unavoidable that the discussions that you also have to have with your clients about whether there is a trade-off between investing on a sustainable ESG basis against shorter-term financial returns. The dynamic of that is undoubtedly going to be nuanced by your own attitudes. If you think ESG and transition is the way forwards, that will come over. If you think it's not, it's a load of mumbo jumbo, then that will also come over in the discussion that you're having and saying, well, if you do this, actually you're going to rule out a load of very good other stuff. We're not in any way saying which bit is right and which bit is wrong, but just saying it is unavoidable as part of that process, you are personally going to nuance it. ESG definitions are much easiest treated when you tackle them at generic rather than detailed levels. It is very easy, as I was saying, to get bogged down in the detail, and that is just going to take you up blind alleys. What is important here is the principles rather than the ticking of every box. So it's to understand that the environmental issues are a preference towards businesses that understand that the world and the ecology is fragile, and also that decarbonisation is not an optional extra, that decarbon rules are happening to everybody and everything. And on the societal aspect, it is to see whether clients believe that long-term benefits are best served by companies that align themselves with the environments and the societies in which they operate. Do they take care of their workforces? Do they do things for the communities around their operations beyond their own workforces? And also on the governance issues, it's the principle of, are companies that use accepted best practice and employee relations and equal opportunities, are they going to be longer term winners than those that use their workforces more as resources to be exploited? But we think, and this is important to us, that we should not look at ESG as an isolated issue. It's not a tick box exercise. And in looking at it in a wider context, we do actually, instead of going through detailed boxes and ticking them, we get to understand our clients better, and in so doing, by providing them with better solutions too. And we think that that wider context should be the blending of those ESG criteria with the understanding or belief of the potentially wider benefits of investing into positive change. That is, understanding that decarbonisation is a really serious and major change to the way modern day capitalism works. And also, COVID is also changing many of the ground rules. What is the client's attitude to that? Do they think it's a good thing? Do they think it's a bad thing? And we think also, this is where we blend in what should already be an integral part of everybody's suitability process, which is the exclusion preferences. And again, it's very easy to get into detail here. And we think that that's, for the majority of clients, that's not going to lead to the right outcome. There will be some, of course, who do want to get into the detail of they don't want in their portfolios. But what we think we should be doing is looking at the generic level of whether we want to exclude contentious issues. And we know what they are. They're hydrocarbons, they're single-use plastics, they're armaments, they're gambling, they are tobacco. They are issues which are generally not good for anybody's long term. So, how do we actually do this? Well, we think that it can be distilled into 4 very simple but actually very insightful questions. And in just doing these 4 questions, we can get a really good overview of our clients' attitudes towards the whole shooting match. So question 1, and having said on the last slide that the exclusions are possibly the least important part of this process, they can also be a very good way to get the conversation going. So as first question, something we would suggest would be to ask the client, do you want your portfolio to avoid investing into harmful industries, such as, and then we give the client a range of possible answers from strongly agree through to strongly disagree. The second question, which is where we're saying that we should think ESG should be treated as one rather than going into separate blind alleys with it, to ask the client, to what extent do you want your portfolio to invest into companies that adopt best practice to environmental, societal and governance issues, including etc., treatment of workforces, sustainability in the supply chain, education, carbon footprint, recycle, do they have circular, do they have linear practices, to what extent are they energy efficient? And again, the same range, to what extent does the client agree with that proposal? And the third one, to tackle the third leg. To what extent does the client believe that the world is changing? We can call it the green economy as we have here, or we can call it the transitioning economy. To what extent do you think we should be investing into renewable energy, clean transport, positive impact on the environment and society, and so on? And again, the same range of answers. And fourth, just an open question. When what is hopefully now a constructive and helpful conversation with the client, is there anything else that we've missed out? What is there a sustainability or transition or objection-wise that we haven't mentioned so far? And we think in just those four, what we think are deceptively simple but insightful questions, at the end of that, you know whether or not your client is or isn't interested in this whole area. You know their attitudes, you know their preferences, they are documented, and you've got the free form opportunity for the client to add anything else to that. And one thing that we do, and we suggest that you might do too, is that you can score in the client's answers. And maybe one way of looking at that, which we would put forward, is that potentially if you get 2 agrees or strongly agrees to the questions, that will probably mean that a sustainable portfolio is the best answer for the client. Some clients won't care. Some clients will think this is fantastic, and can they get very keenly involved, please? Some will be amazed that we don't already do this. Isn't this just common sense? It's the way the world is. Why is this a separate issue? But we would argue, and we think in our experience so far, is that the majority are likely to think, yeah, that all seems pretty sensible. That's good. I get that. You're my advisor. I trust you. As long as you tell me that the financial performance isn't going to be worse, that the financial performance is also going to be fine, and my money does what I need it to, absolutely, let's do this. And just towards the end, this is where it gets complicated, because having done the process of understanding the client's motivations and the client's needs, sustainability and ESG wise, how does that then translate into an investment process? And this is the tricky bit, and hopefully this is where we're going to come in, because your investment process has got to match those suitabilities and needs to what's available investment product. And how do you do that? How do you understand that? So if you have a fund which purports to be ESG, how do you understand whether it actually means it's ESG, or whether it's paying lip service to it? Or if there's an exclusion fund, what are the exclusion criteria? Are they actually any good? Does it actually work, by the way, screening companies according to percentage of turnover? And if you do, what are the outcomes on that? So if you rule out all hydrocarbon businesses, for instance, you'd rule out one of the sustainable darlings of the world, the Danish company Ørsted, which was previously called Dong Energy, which is Danish oil and natural gas. Its history is a hydrocarbon business. It still has some oil and gas assets, and it will be screened out. And so on and so on. It is a minefield. There is third-party data there to help you if you want to try and do that yourselves. Primarily for our industry, that appears to come from Morningstar. But I and we are going to argue that you actually can't just take that Morningstar data and use it without understanding all of the previous questions. to be able to construct a portfolio just on Morningstar ratings, we would argue very strongly is not going to achieve the client outcomes that we want to get from this. So we're going to say, well, why don't you consider outsourcing? Why don't you consider outsourcing to an investment business that has been doing this for a number of years, has a strong and proven process, has a track record, and has an IFA focused solution to the whole sustainability and ESG issues in a branded sustainable world service. And this is where I can hopefully use the technology to transition onto the second half of the presentation, where James Clark is going to take us through Hawksmoor's Sustainable World Service. James, fingers crossed, you've got control.
I do, Jim. Thank you very much. Good morning, everyone. Thank you very much for joining us. My name is James Clark, Fund Research Analyst at Hawksmoor, and I offer you this morning a quick tour through our Sustainable World Services and what we actually do at Hawksmoor. And we start with this slide, our 3 pillars. We came up with this framework in early 2017 to help us, as we were developing our work in sustainable investment, to think about the different types of sustainable fund that are out there for investors. Because as Jim alluded to, there's a really wide range of approaches to sustainable investment, and we wanted to try and make sense of it and think about which kind of funds we should be investing in. So we came up with this simple framework: impact, integration, and exclusion. And we're going to touch on each one of these in just a second. But just before we do, I wanted to mention our fund research process here, because it's really key to what we do. And as Jim mentioned, you really cannot just rely on what's in the name of a fund. There's no substitute for doing the research work here. We do a lot of meetings and calls with managers, working out what the exact sustainability approach is and running the rule over that effectively, working out what people's investment style is, how portfolios are positioned and why that's the case, how they've performed historically and how we might expect them to perform going forward. So there's a lot of work to be done, and we can and do that. And it helps feed into this framework, and the framework in turn helps us advisors, our investment managers, and ultimately clients to make sense of the different approaches to sustainable investment. So what are those approaches in our view? And we start with impact. So these are, in terms of collective funds, these are positive impact funds, which are generally the newest, most recently developed cohort of funds. They often have an objective, and investment performance objectives, such as outperforming global equities by 2% per year, and a positive impact objective based on the environment and or society. And therein, funds generally invest in a particular number of themes. Themes such as you can see on the slide here, improving the efficiency of using natural resources, or focusing on healthcare or quality of life. These kind of funds generally don't even need traditional negative screening, because there's no way that they're going to invest in a alcohol producer, for example, or an arms manufacturer, because those companies are not going to achieve the kind of positive impacts that they're looking at. The second category for us is integration. And this is really where the ESG factor integration that Jim highlighted comes in. In terms of funds, we're looking for some tangible positive screening over and above the simple traditional negative screening, which we'll come on to in a moment. So this is looking for companies with positive characteristics, such as those providing healthcare or education for their workers in developing countries, those really focusing on supply chains and well-being within those supply chains, those really looking after the environment and having good things like health and safety policies that are really best in class. Now, these kind of funds can also pursue themes, but the key is that we're really looking for positive aspects here. And the third category for us is exclusions, which are your older, longer established negative screening funds. Now, the vast majority of the funds that we're involved with here have got really very comprehensive negative screening, screening out 10, 12, 14 different categories of contentious activities. And these are all the kind of things that Jim's touched on already. So fossil fuel production, arms manufacturing, alcohol producers, nuclear weapons, nuclear power in some cases. So Jim's also touched on some of the issues surrounding this, for example, using the proportion of turnover approach, but that's how it's generally done, either by analysts within a fund management group or within a third party, such as MSCI or Sustainalytics. So it's also important to say here that we don't look down on these kind of funds. They are certainly the longest established, but we've got some really good funds here in this exclusion category. Now, also for us, somebody has to draw the line in the sand in terms of how strong a screening process is. And ultimately, we're running the rule over a negative screening process. And for us, a reasonable minimum standard would be the presence of 5 exclusions that pass muster. Our lightest green, if you like, fund that we invest in at the moment has got 7 categories of negative screening. So there's a quick introduction to our framework and our categories, but how does this all come together into a Hawksmoor portfolio? Well, it does so like this. This is an illustrative portfolio from the bespoke discretionary side of sustainable world. So first thing to touch on is the different tinges of colour here. So we've used red for the exclusion funds, yellow for the integration funds, and green for the positive impact funds. So the most important thing is to show and emphasize that we can and do use funds from these different parts of the framework in real life portfolios. The next thing to touch on is really the risk score and considering where you use different kind of funds in different portfolios. So if we look, for example, at the international equities section of this portfolio, you'll see that in general, the exclusion funds tend to be slightly less risky than ESG integration funds, with positive impact funds being slightly more risky, typically. And that makes sense. And also, when it comes to portfolio construction, we would not pack a lower or lower moderate risk portfolio chock full of positive impact funds because it wouldn't really be appropriate at that level of risk. Equally, with a more adventurous portfolio, we wouldn't pack it with the simple exclusion funds because we think we could do better than that in terms of accessing some really good positive impact funds. There's a really good breadth of funds here. So you can see everything from fixed income, where there's even strategic bond funds available in this space, right the way down through some of the investment trusts that we can use in the bespoke discretionary service, such as Target Healthcare REIT, top-end care homes, and JLEN Environmental Assets with their renewable energy assets. So you can also see here a column about sustainability scoring, and I'll flick on to the next slide to touch on that in more detail. Alongside our risk scoring of assets and of portfolios overall, we also now do this for sustainability scoring, which is really thinking about the impact and execution of companies and funds. And we have a scale between -5 and +5 to reflect how we think the sustainability qualities of a company or fund stack up. And if we look at just a couple of examples from the direct equity side of things, British American Tobacco for us scores -2 on impact, i.e. what they do, and a 0 on execution, i.e. how they do it, giving an overall score of obviously -2. Whereas on a much more positive side of things, Smurfit Kappa, which is a manufacturer of recyclable cardboard boxes, is actually one of the world's largest recyclers of cardboard, doing over 6 million tons a year at the moment. Smurfit Kappa currently scores for us 2.5 and 1.5 on the 2 parts of the score, making obviously 4 overall, which is a really strong sustainability score. But we're doing this for funds and for direct equities. And for the Sustainable World Service, we have a minimum individual sustainability score of 0 and a weighted average portfolio score of 2, ensuring that only genuinely sustainable companies and funds can be held in this manner. So we've touched on funds, direct equities, but this is not just about doing our research, selecting a few investments, putting them together in a portfolio and saying, there you go, we can do sustainable investment. It's about allowing investors the chance to align their investment objectives with supporting the UN Sustainable Development Goals. More and more of the funds that we invest in are mapping their companies, their holdings to supporting the Sustainable Development Goals. And more of those funds are producing impact reports each quarter, each half year, or each year. Now, we think that we can reflect this at portfolio level as well and give, as I say, investors the chance to support the Sustainable Development Goals. There's more work to be done here. We would like to improve how we report on this and how we map this within our portfolios. It's very much a developing area, and we're looking for more funds to progress with this as well, which would help us at the portfolio level, ultimately as an investor in funds. So developing area for us, and one that we'd like to continue to do so. So what do we actually offer in terms of services? Well, there are two avenues, if you like, for Sustainable World. They are bespoke discretionary and model portfolios. Firstly, on the bespoke discretionary side, we've been developing this work really since late 2016, early 2017. So these are using the same frameworks, processes, and procedures as for what you might call traditional investment. These are bespoke portfolios managed by the same investment managers in the same offices for Hawksmoor. The only difference is that we run a buy list of sustainable funds, investment trusts, and direct equities, and therein we can cater for specific client exclusions. Important to point out here that we actually have a lower minimum investment amount for Sustainable World than for what we might call traditional portfolios. So that's at £50,000 rather than £100,000. And equally important, there's no premium charging for Sustainable World. We don't think it'd be right to do so. We don't think there's a need to do so. Our research process is very similar. And as I say, our portfolio construction and all of our other processes are the same. On the model portfolio side of things, our oldest Sustainable World model portfolio, the moderate option, has been around since July 2018. And in February 2019, we added 3 more options: cautious, adventurous, and equity risk. We've got just a 0.25% AMC on these models, and we're available on 8 different platforms. Now, touching on the performance of one of those, on the model portfolio side, using our oldest portfolio, so the moderate, you can see the chart here as at the end of August. So since launch in July 2018, this model is up by 9.4% against 4.4% from the ARC Sterling Balanced Asset Comparator. Looking at the illustrative portfolio on the bespoke discretionary side of things, this one's been around since March 2017. And again, as at the end of August, this portfolio was up 23.7% against 9.3% from the same ARC Sterling Balanced Asset Comparator. So performance is really good. And just to wrap up my section, we've got some genuinely excellent funds available at our disposal. We do a lot of research work, a lot of monitoring. We're looking to expand things even more. We've got some really good processes in place. Much of it, as Jim alluded to, is building on what we've done for years in the bespoke discretionary space in what you might call traditional investment. And things are really going nicely and really coming together. At the same time, this is really just a quick whistle-stop tour through Sustainable World with not a great deal of time at our disposal this morning. So if you would like to know more and you'd like to really dig into things, we'd love to have another call with you directly. So please do discuss that with a member of our business development team. Thanks for listening to me, and I'm going to hand back to Jim to wrap up.
Right, thank you, James, and thank you for listening, everybody. So we've been through that ESG is going to be a regulatory need coming all our ways. How we can either treat it as a bit of regulatory red tape and more work that we have to do, or use it in the wider context and the wider sustainability and transition context with carbon and with COVID to have better conversations with clients than we've had previously. and to use those better conversations to end up with better outcomes for them. And also how hopefully Hawksmoor can partner with you in providing those better solutions for clients. We've got a little time for some questions that have been coming through online, thank you. First one that we have is a screening question, and an interesting screening question, it being, will funds with cannabis stocks ever pass people's screening processes? And it's a very insightful question, actually, because cannabis is something that one might naturally think ought to be screened out. It's a recreational drug, but it is also something which has potentially really exciting medical application. And James will probably have something else to add to this, but my reaction is that although we don't currently have any cannabis exposure in any of the portfolios, that medical cannabis is something that we would not rule out from inclusion. We'd like to invest into novel and improving medical treatments, and cannabis has that potential. James, is there anything that you'd like to add to that?
Yes, thanks, Jim, and thanks for the question. Very good one. Yeah, my thinking would be along much the same lines. I mean, I think for us it would be about understanding the fund level screening relating to any cannabis stocks. So it wouldn't necessarily be us screening out cannabis exposure. It would be understanding about how, for me in particular, about understanding how funds screen out cannabis related companies. But I'd concur with Jim. I think there are going to be some very interesting medical related advances in this area of pharmaceuticals. So I would be keen to understand any screening process related to cannabis, and if we came across a fund or one of our existing funds started screening out medicinal cannabis, then as part of our research work we'd certainly look into that and question that. It's not a screen that I've currently come across on any of our funds, and I think that's because it's a really nascent area with relatively few specialist companies in this area, and therefore relatively little need for those funds to do that screening at the moment. But I'm sure it's growing, and I'm sure it will become a part of fund screening activities, and that's when we'll come to look at it. So an interesting area, but not one that we've hugely come across just yet.
Great, thanks, James. Next question, which I think is a very, very easy one, actually, and excuse me whilst I glance sideways whilst I actually read it. And the question goes, given the performance of technology stocks in the market downturn, is there not an argument for including a sustainable bias in all portfolios, irrespective of client preference? Yes, absolutely. If you have any belief in COVID changing the world, or decarbonisation being a fact of life for the coming decades, or that the UN is right that climate change is the greatest risk that the world faces, then absolutely all portfolios should have exposure to companies which understand these themes and these ideas, and these are most easily one most easily gains access to them by buying sustainable funds. There's a lot of hard work to be done in researching those funds and making sure that they are doing the right things. But the answer is, to the question, should every portfolio be exposed to these things? The answer is yes. James, is there anything that you want to add to that?
Just a little, Jim. Again, thank you for the question. Yeah, I just wanted to say that on the bespoke discretionary side, we're seeing more and more of our investment managers use our chosen sustainable funds within, again, what you might call traditional portfolios. So we're seeing some really good take up from clients who are not necessarily signed up to specific sustainable investment. So our investment managers are using these funds as part of broader portfolios, which is great to see. And similarly, on the model portfolio side of things, which we as a team manage, we are using sustainable funds again in traditional portfolios as well for diversification benefits and to access these themes, which we think are really strong over the well, all time frames really. So ultimately, again, I concur with Jim. So I think the answer is yes, definitely.
Yeah, absolutely. Thank you, James. The fact that a number of these funds might have sustainable in their title is sort of by the by. They are investing into the industries present and the future that we absolutely want to be in. Question, are we going to be emailing copies of the slides? I think the simple answer to that is that the slides will be available very shortly on Hawksmoor's website. As to the specific emailing of them, not absolutely sure, but I will revert to the sales and marketing teams, and if we can do, then we shall do so. And the wonders of technology, the sales team has just said, we will be emailing them out. So the answer is yes. Very good. We've probably got time for one or two more. Just one more coming in at the moment. Are there any comments that we can make about the individual performances of the three pillars of impact, integration, and exclusion? Have there been any different performance characteristics that we've noticed, which is absolutely one for James?
Yeah, again, thanks for the question. Very good one. Yes, we see particularly year to date, the best performance from the positive impact funds, particularly in global equities, where there've been some really, really strong performance. Funds picking up on and investing in stocks such as Tesla, which have been really, really strong. And so the one that stands out for me is Baillie Gifford Positive Change, which has been one of our best performers across the board recently, both in the short and medium term. There's been no poor performance below that. We've got some integration funds that have been performing really well. If you go back slightly further, they performed really well in downturns, like in late 2018 and last year and into this year as well. And there's been no notable poor performance anywhere. But back to the question, yeah, I mean, I think positive impact's been the best performing area.
Very good, thanks James. And I think final question for this morning is on are the sustainable world portfolios available on many platforms? The answer is yes, they are currently available on 8, and you've been testing me that I can actually name those 8 off the cuff. So Sustainable World is currently available on Aegon, Aviva, Accentric, Standard Life Wrap, Transact, Novia, 7IM and Nucleus. And we are hopeful that between now and the end of the year, or hopefully shorter than that, that they will also be available on Hubwise. And I think on that note, I thank everybody very much for your attention and your attendance this morning. I very much hope that it's been a worthwhile session for you. If you have any further questions about anything that we've mentioned or anything that we haven't mentioned, please do get in touch with us. You have the details of all the business development team on screen in front of you. And we very much hope that we'll be able to have conversations with you very shortly. Thank you very much indeed, everybody.